I'm Roger Lasad and I love real estate. Welcome to my channel. This is episode number 10 and I'm asking, are we still in a buyer's market? Let's get into it, guys. All right, so I'm sure everyone has seen the news. Interest rates went up. They're predicting another quarter point raise in July and maybe another quarter point. I'm saying quarter point. I mean 3/4 of a point raise just happened. They're predicting another 3/4 of a point raise in July and then possibly another one, I believe, in September. I mean, it's happening, people. We could potentially see mortgage interest rates as high as 7 or 8%. But the big question on everyone's mind is this a good time to buy or should I wait? Well, let's break this down. Right now, I hate to be the bearer of the bad news. We are still in a seller's market. And what is a seller's market? What is a balanced market? And what is a buyer's market? Everyone out there is talking about the impending real estate crash or the dip or the drop and how it's going to all of a sudden go from a seller's market to a buyer's market, and everyone glances over the balanced market. So before I answer the question of are we still in a buyer's market, let me define the different markets. Right now, we're in a buyer's market, and what does that mean? It means very low inventory. How do we know that inventory is low? It's very simple. If the majority of the homes in a market, whether it be a local market, regional market, or national market, are selling under a certain amount of time, we know it's a buyer's market. Generally speaking, it's a seller's market. Generally speaking, you like to say that if the homes are on the market for less than 90 days, it's typically a seller's market. Because when you think about it, most people do buy homes in cash, which means financing, appraisals. A lot of things have to happen. So if they're selling within 90 days, as in going to the closing table within 90 days, what that really means is that they got into contract probably 30 days out from the 90 days. So in reality, they're going under contract a month to 2 months after being on the market. Now, what we've experienced, especially in the South Florida area, is homes are, if you could believe this, are going off market in 30 days or less, which essentially means people are putting their homes on the market and within a few days they're going under contract and then 30 days later, boom, gone, done. In fact, last year, interesting fact, in Miami, 40% of the homes were purchased as in all cash. Yes, 40% of the homes were purchased all cash, people. I wasn't mistaken. I did say that. And those transactions can go from contract to closing in about 2 weeks. Sometimes even less, because sometimes people they don't care about an inspection, appraisal, they just want it. So boom. So that's a seller's market. Now, what would be considered a buyer's market is when homes are on the market and they're staying on the market for 6 months or more. So at that point, you've got the first 2 weeks, by the way, which is probably the most important time when your house is on the market, where the seller and the listing agent, they're very excited. They're happy. They're like, we're going to do this. We got a great price. We're going to get a lot of people in. However, that first 2 week is what the agent uses to gauge interest in the property. If they get a ton of interest and a lot of offers, they're probably going to keep the list price as is. However, it is pretty typical that if interest is low and you don't get any offers, then that's basically the market telling you that it's been overpriced. Now, the next big benchmark is around the 30-day mark, where if it's been there around 30 days and you're still not seeing the activity that you want to see, you're going to want to do a price decrease. And essentially, this is how it's going to work. Depending on the market, it could be every 2 weeks, every 30 days. But as you can see, the longer the house stays on the market, the less enthusiastic the owner is going to be, and the agent, the more frustrated the owner is going to get with that agent. Or if the owner is doing it on himself, the more frustrated the owner is going to get with themselves. And as it progresses, you see more and more price decreases. Not to mention if this property had some type, if they were selling or had some type of strong motivation to sell the property, i.e., they had to go out of town because of a job, or not go out of town, but they're moving from that property to maybe another part of the country because of a new job situation, or if they're under some type of financial distress, or they wanted to trade up. Obviously, that house staying on the market for a very long time is going to make that seller more accommodating to receiving less money, which is, I'm sure, what everyone here likes to hear. And they want, everyone's always talking about, I want to get a deal. Well, that would be some of the motivations that would cause you to get a good deal. So the key point is here is the longer the house stays on the market, the less money the seller is more likely to accept. And that's why that's called a buyer's market. Now, before you go from a strong, and in this case, an insanely strong seller's market to a buyer's market, there's an in-between phase that is called a balanced market, which, if you look back historically speaking, that's where most of the time the market has been. It has been essentially a balanced market, which means you're looking at properties being on the market for around 6 months or so. And that's where you'll get a lot of give and take, some negotiation. You may be able to find some pretty good deals readily, but at the same token, this is where it really becomes important that you or your agent that's representing you knows how to negotiate, not just on price, but other things that the seller may want. So with that being said, I hate to be the bearer of bad news once again, but I'm telling you guys, we're currently still in a seller's market. Now, is it as strong as it was a couple weeks ago? No. We're definitely seeing more price reductions. And hold on, guys. I did say price reductions, not deals. We're talking about people that were pricing their properties like $100,000 above what would be considered market price, and actually getting people willing to pay that. We're talking about are people getting 20, 30 offers the same day it goes on the market? No, not so much, but they're still getting 3 or 4. So still a very strong market. And I know everyone's like, hey, Roger, if the interest rates go up like crazy, wouldn't that mean that a whole bunch of people aren't going to be able to afford to buy, which means that there should be way more inventory? As I stated before, in Miami last year, 40% of the homes were bought with cash. So 40% of the buyers don't care about interest rates being high. Then you've got a chunk of those buyers that do care, and okay, they will be taken out of the market. Or, and here's one other thing that people never think of, or some of these people might now want to buy in panic mode because they're afraid that the interest rates are going to go up even higher. That's right, guys. No one thinks about that. Listen, the fear of missing out is real. And There are people that when they feel like they've missed out, they will try to catch a falling knife. I mean, it is what it is, guys. I mean, it is a thing. So with that being said, you can, I mean, obviously it's not a whole bunch of people like this, but you will see some people jump in because the interest rates are going up. The same way, when stock market's going down, people sell, and then as things are going higher, because people were waiting for the bounce, they missed the bounce, and then they're like, well, it's gonna dip again. I'm gonna wait for it to dip again, then I'll buy that bounce. Oh, they missed that again. It keeps going, and they're like, oh my God, what did I do? I've got to jump into and get some of that now. That's what I anticipate. That's what's gonna happen with some people because, like I said, the Fed is basically telegraphing at least two more interest rate hikes of 3/4 of a point, which would be another 1.5%, which I know for you big ballers out there probably doesn't make much of a difference, but to a lot of people, another 1.5% um, on their mortgage will make a big difference. So I could see some people jumping in there and buying something just to avoid having to lock a much higher rate in. So there's that. And then you have some people that will actually bow out, but right now, market's pretty strong. Now, once again, real estate is a very location-specific business. So some of you guys out there might say, hey, Roger, in my area, I've definitely seen some huge price decreases, which is understandable. But for me, in the Miami area, the Fort Lauderdale area, yeah, I'm not seeing significant price decreases. If anything, I'm not really, well, I say price decreases, but in reality, the prices are just correcting from ridiculous to more reasonable. But as far as it dipping to where people will feel that, oh, this is such a great deal, that has not occurred yet. And I will definitely let you guys know when I do see that. And then while we're on the topic, let's talk about what people consider to be a deal, which that I'm a little unclear as to what's going on with people when they talk about deals. And I'm beginning to suspect some people think that because a house was on the market for 800,000 and they got it for 725, even though maybe the comps say it's really supposed to be around 730, that they feel that that's a deal. If that's what you guys think a deal is, please let me know in the comments, because deal to me essentially means if the property is $100,000, for instance, just to keep the math simple, and that's pretty much right at market, and you get it for 80,000, 20% below market, that's a strong deal. But the problem that I have with people is in 2019, houses that were 600,000 went to 700,000, and now they're at 800,000. So to some people, I get the feeling that they will see that as a deal if that $800,000 house they get for 7 or 725, even though they could have gotten the same house back in 2019 for 600 at a much lower interest rate. Really thinking that's what people are thinking out there, because the conversations I'm having with people that I've been talking to about real estate since 2019, in some cases before that, that kept waiting for this crash that people have been talking about since 2016 that has yet to occur. I guess that's what they're talking about, guys. So, and from my experience, I'm also thinking that these are going to be the same people that if there actually was a crash, that they'd be too afraid to buy the properties at crazy prices, because they were like, oh my God, I don't know where the economy's going to go. They've laid off a bunch of people. This is not a deal. It's probably going to go down further. People, don't be one of those guys. I mean, you can't be Chicken Little, because it can't be the sky is always falling when prices are going up and the sky is always falling when prices are going down. And that's what I'm kind of hearing from a bunch of people that reach out to me with concerns. Because some of these people, they were the same people that during the financial crisis, like, they had money and the last thing they were trying to do was buy anything when stuff was on sale. So anyway, guys, to conclude, we are currently still in a seller's market. Before we go to a buyer's market, we will most likely experience a balanced market for several months before we even move into a buyer's market. And this is what I like to, this is why I like real estate so much. It's not like the stock market or other assets that move at the speed of light. If you pay attention, you keep looking at your local market, you read, you talk to people, you see where sentiment is. You keep, keep looking at the listings in your area and note things if you're seeing price reductions, note how long it's taking for things to sell. You can kind of get a pretty good picture of what's going on in like a month or two of your market. What type of market it is, what direction it's going in. And that's why real estate is called probably the most forgiving asset class out of all the asset classes, because it moves as a slow pace, which is why they also say you can't get rich quick in real estate, but you can get rich slow. But anyway, guys, I'm Roger. I hope you found this video helpful. If you do, please hit the like button, comment, and subscribe, and I will be back soon with another video. All right, guys, take it easy and have a good night.